Traders are running towards bond markets, triggering a sharp surge in yields amid uncertainty brought by U.S. President Donald Trump's sweeping tariffs. Jin Kim has more.
Amid escalating trade tensions and political uncertainty in the United States, investors are dumping both U.S. stocks and treasuries, triggering a sharp surge in yields.
That has hurt the U.S. Because, yeah, right. I guess President Trump didn't realize that the yields of these bonds would go up so high when people were selling. So it's a double whammy.
The question now, can the Philippines stay shielded from the global sell-off?
We're not that insulated or we're not that shielded considering the sensitivity to how the local markets react to the U.S. Treasury yields. But one thing to consider, or at least a positive thing to consider, is our credit spread versus the U.S. actually tightened quite a little bit. But on the local end, it will continue to be directly affected with heightened volatility in U.S. credits, in U.S. treasuries, especially with the upcoming supply.
Well, on one hand, in the past, right, when the U.S. sneezed, we catch a cold, right? So there is still that. We're still coupled to the U.S. to a certain degree. I'm just hoping that because of what's happening, people now will look for other alternatives, and they will see that Asia, specifically Philippines, is a good investment.
In the latest developments, Wall Street futures inched up after the White House announced that smartphones and computers from China will be exempted from the new tariffs. As global uncertainty deepens, foreign investors are taking a wait-and-see approach, parking their funds in short-term instruments while waiting for more favorable conditions.
I guess if I were to give advice to investors is stay on short-term securities for now, for the time being, until the storm passes. There's a method to this madness. At the end of the day, I think generally yields will move lower in the long run. But in the short term, we have to just maybe swallow a bitter pill at this point in time.
If you want to be safe, is gold, and then especially if you're in the Philippines, then the peso is strengthening, so white dollars you'll have a loss. Stick to your local currencies. So buying Philippine corporate bonds and buying Philippine equities, especially the good dividend-paying ones, are still going to be a good investment.
Francisca says many investors have already reduced equity exposure and are shifting to AAA-rated corporate bonds offering yields of 6 to 6.5%. He advises locking in long tenors while long-term rates remain high before monetary easing begins in the months ahead. Jin Kim, Billionaire News Channel.